Hello, everybody. Happy Tuesday today. Hope everyone is doing well. Market hanging in here, but trending down a little bit, probably just off of these couple of tweets over the last couple minutes from President Trump about potentially getting involved in the war. So it's probably why we just sold off 10, 15 points in S&Ps, but nothing really big to write home about yet. Anyway, VIX is decidedly higher today, back above 20 at about 2060 at this point. But hello, everybody, and happy Tuesday. Let's get going here. What we need to do first, as always, is hopefully have everybody hit the subscribe and like. Please do that. Smash that. Would appreciate it. Hit the subscribe button. That would be fantastic and help us out a lot. Today, we are going to talk about calendar spreads, and we're going to talk about them. It's really a two-part discussion. Regular calendar spreads and then calendar spreads that we do, which are designed around earnings, which there's a totally different concept way to look at things. So today we're going to be focused just on regular calendar spreads. Harris, Brad, hello. So when we trade calendar spreads, we are always on the long side of calendar spreads. What does that mean? That means we're always buying them. And I'll go into why we always buy them and not sell them shortly, but that is exactly what we will be focusing on, is buying them. But why, when, and how? You know, when do we want to do that? Before I change screens here, when is there a really good opportunity to buy a calendar spread? What would we look for? Anybody, if you want to comment on that, remark on that, that would be great. Hello, Eric. When is the good time, proper time, where calendar spreads really can outshine other types of strategies? Excellent. Bear, low IV. Okay, Connie, you said high IV. Okay, after earnings, when vol is cheap. Earnings. Don't forget, today's conversation is going to be about calendar spreads, not on earnings, because it really is a different sort of valuation that you have to go through. Okay, so maybe we'll pick that up tomorrow. We'll do calendar spreads around earnings. But really, calendar spreads, we want to buy time. Okay, we want to buy time. Excuse me. When is the best opportunity to buy time? When vol is cheap. Okay, so essentially what we're doing is right here. Okay, we sell an option. And again, calendar spreads can be either bullish or bearish. They could actually be neutral too if we use strikes that are right at the money. But you sell a shorter term call or put, could be this week, next week, could even be a month from now, whenever it is. And then you buy a longer term, same strike, okay, longer term option against that. Okay, and the reason that we always buy these spreads, okay, instead of selling them, is right here. It is capital efficiency. Does not take up a lot of buying power whatsoever. Calendar spreads are 100% risk defined. If you buy a calendar spread, that is the most you could ever lose. Okay, and a couple of the reasons, again, why you would do that is, A, if vol is really cheap, you're buying time on sale, and you're also able to take advantage, as we have here, of more rapid time decay in the shorter term option. Okay, now you can sell calendar spreads as well, but we don't do that because the margins that your brokerage firm, that your clearing firm will charge you are astronomical, because the way that clearing firms look at a spread like that is not that you have a long and a short as a hedge, but they look at it as if, okay, what happens once your long, shorter term expiration option goes away? You're left with a naked option out in the future, whether that future is a day, a week, a month, however long. So that is a massive, massive capital requirement. It would cost you a ton of margin. And that is why we don't sell calendar or, quite frankly, diagonal spreads either. It would be a great tool to have, because there are definitely appropriate times to do that. We don't do that, though. Okay. So again, here's how you set this up. Okay. On the long side, selling a near term. And again, that near term could be a day, a week, a month, could be 6 months if you're buying something a year out against it. Okay. So that's considered a long calendar spread, and the short calendar spread is just the opposite. Okay. So on a long calendar spread, as I said earlier, we always know what the maximum risk is. Okay. The maximum risk is the debit that we pay. Can never lose more than that. But on looking at the potential profit, you cannot calculate that, because we don't know what's going to happen at expiration when one option expires. Is it going to be rolled out? Is it going to be closed out? So when we do our calculations, guys, like when we do those P&L spreadsheet analysis, you'll come to realize that when we do those, we only do those on spreads where we're looking at options with the exact same expiration, because you cannot calculate when you have two different expirations. Does that make sense to everybody? Good one, Robert. Does everybody get that? Everybody understand that? Excellent. Excellent, excellent, excellent. Now, as I put in here, that is typically what we will look for, is a double. Meaning if we bought a calendar spread at 80, we'd look for $1.50, $1.60 exit or so. But you can't really calculate that profit range, okay, with an exact number. We can project out and push the data head on our risk analysis to an expiration to see where things might come out. Okay. Now, where do we want a stock to move if we have a calendar spread? Anybody? Where? Yeah, always. Same answer, guys. Never going to trick you with that. Always, always, always the short strike. Because the short strike in a calendar spread, if we get there at expiration, that's kind of the goal, to have that option that we sold against our long option be worthless. Okay. One of the reasons we talked about why you would buy a calendar spread when vol is low is because as vol starts to creep back up, or if the potential is there for implied vol to start creeping back up, does that help a spread where you own a longer term option, or does that hurt that spread? An increase implied volatility helps which option in a calendar spread? Yeah, Connie, definitely helps. The further out option that you own, the more time, the more vega impact there is as volatility changes. So that's why we want to take advantage of those types of situations when vol is really, really cheap. Okay. I took this screenshot. This was from earlier this morning. This is AMD. Okay. And I'm only using this as a sample discussion here. Okay. But earlier this morning, we saw AMD trading up around 129. Okay. And the reason I chose AMD is because easy to just say here, let's look at a sample calendar put spread because the stock was right there at the 200-day moving average with some potential resistance. Okay. So what I looked at and what I'm going to underline here, here's the implied volatility in AMD. So if you look at this, this is setting up as an ideal time to buy time, whether it's a calendar or a diagonal, because you can see how inexpensive implied volatility is. So one of the things to monitor is, yes, a rise up in implied vol is great for a calendar position, but we also have to look at what if it doesn't move up, right? Are we at a point where, you know what, the probabilities of vol going down are really small? So even if vol doesn't go up, is it going to hold these levels? Well, when I look at AMD here, I'd say we're in a pretty good spot with, you know, little risk to vol going down and more probability of vol going up. Does everybody see that? So we absolutely have to take into consideration where implied volatility is, whether it's on an index, an individual stock, whatever it is. Got to look at that. Okay, everybody understand that? Great. All right, let's, before we go into an example here, let's go to Thor. The new mascot, Thor, back in the house. Thor's word today, he told me earlier this morning, calendar. All right, give you guys a minute or two to get that up there, and then we will go into an example of how we would look at what strikes we want to trade and where we would place a potential setup. Okay, so first thing we want to do, just like with any other position we're going to take, you can either look at implied vol first, like we did here, and we could see that, okay, vol is really cheap. So that's going to at least direct me to look at some time spreads. Time spreads are calendar or diagonal spreads. So if you hear the terminology time spread or read that somewhere, that is what that is. Okay, so the stock was 129-ish when I pulled this data. So I'm going out to next week. Okay, because in this example, we're looking to do a time spread selling next week's option against something that's a little bit further out in time. So what are we going to do here? Well, we're going to look at the money straddle. What is the expected move going out to next week? And here we can say it's about $8. Okay, does everybody see that? That's what those arrows are for. They're pointing to the money on the 129 strike call and the money put. Okay, so does everybody see that? Great. Okay, so now what I'm going to do is, it's really important to understand also, is there an event coming up? Meaning, is there an earnings event in this possible stock that we're looking at? So when I look at AMD, earnings are not until July 29th. So if I am looking for a calendar spread and not wanting to take the risk of earnings, I'm going to choose an expiration before that earnings date. Okay, if we're doing it for earnings, completely different conversation we'll have. But typically, if it is just the opportunity to buy time, I don't want to have that long option be affected by earnings. So what I did in AMD here, and I looked at next week's short, and then I just went out all the way to July 18th, regular July expiration. okay, where you can see that implied volatility at 43% is still incredibly cheap. So in this example in AMD, we would look to sell the 120 put expiring next week. And go out and buy. Again, I only looked at July 18th just because it's before earnings. You can choose any expiration you want. But we're going to look at the July 18th, same strike, 120 put. Okay, so that spread probably costs somewhere $1.70 to $1.75. Now, what do we get for that? What do we get for that? Well, as we mentioned earlier, we get much more rapid decay on the short option. Okay, so we get to take advantage of theta on a calendar spread. We get to take advantage of any increase in implied volatility because that is going to help our long option more than it's going to help the short option. And then depending on the length of time that you go, calendar spreads or diagonal spreads also give you the ability to roll and even collect more premium against our long position. That's why calendar spreads are so incredibly efficient. They work great in these low volatile environments, and they allow for a lot of manipulation, positioning, rolling, whatever you want to call it, adjusting the position. They allow for that. And so we definitely take advantage of that at times. There's no question about it. Any questions here so far? And you can see what I wrote at the top here. If implied vol is really low, I want to buy time, typically at least a few weeks. I want to get time on sale. Okay, premium on sale. Now, in a calendar spread, this is what we want to see. Stock move to the short strike. Okay. If it doesn't get there, or if it moves too far, okay, even though you may have directionally the right directional spread on, like in this case in AMD, we were talking about the 120 put spread. Okay, but not really, Bear. No, not really. Not really. So when we look at this, if you move too far away from the strikes, okay, what happens? I want everybody to think of this. What happens to the extrinsic value or premium in an option the further and further and further you move away from a short strike? What happens? And Dave, I'm willing to pay, if the volatility is right, I'm willing to pay what the market is showing and then just size my trade appropriately. Aladdin, great answer. Great answer. The further you go away from at the money or the short strikes, the less premium, the less extrinsic value is left in an option, which is why the further you move away from a short strike, the worse the position gets, with, again, that max loss being capped at what you paid for the spread. Okay, so everybody understands that, right? That the further away out of the money or in the money you are, the less premium, the less extrinsic value an option has. So this is what the P&L of a calendar spread would look like. Okay, so you can all read this. If you want to take a screenshot, you can take a screenshot, whatever it is. But calendar spreads in options summed up. Very, very risk averse strategy. Very risk averse. Very efficient. Selling the shorter dated option, longer one. Okay. They do not take up much buying power. And yes, because I get this question all the time. Yes, they are allowable, tradable in a retirement or IRA account. Okay. Both strike prices are the same. Different expirations, same strike prices. If you have different expirations and different strike prices, that's a diagonal. Same concepts as a calendar spread, but a diagonal, because of the strike differential, typically will give you more direction, more delta bias to your trade. Okay. And really good in low IV environments. They're also really good around earnings too, but it is a total different concept, and we will go through that. Well, Connie, what I'm doing is go back here in AMD. I'm looking at what is the expected move to the short option, right? Where do we want the short option to go? The expected move here in AMD going out to next week was about $8. That puts us right down in this range right here. So if we get that move by June 27th, what's going to happen is this option that we sold, this thing's going to hover right close to zero, while our long option, which has an additional 3 weeks of time here, that thing's going to increase in value. Okay, Gladys, there really is no best practice because it all really counts on some factors out there, like, is there an earnings date that could impact this? Is there another event? Is there another day off in the marketplace? But typically best practice would be is if we are in a really low implied volatility setting, I want to buy as much time as possible and not have an earnings report included in that. Okay, if we're going to exit in and out, we always do it together. We do it as one trade together, one spread. Legging in and out gets you, can give you some market risk based on what happens there. Sure. Connie, we don't have to wait for it to get to expiration or wait for a roll. We can sell it out at any time. Okay, I want to, and I'm going to put a link up here. Charlie Moon is doing a live webinar tonight, everybody. Okay, on using AI and the tool that he uses in his room. So if anybody is interested there, I just put a link up in the chat, and you can all look to that. Would love to see many of you on here. Charlie always does a great job with his webinars. I'm sure it will be a great one tonight. All right, guys, the wheel is closed. Let's open it up and bring it in here. Okay, I'm going back here. Yesterday's winner was Gilbert. So Gilbert, if you are on the wheel today, less people on the wheel, a lot less people on the wheel today. Okay, are you on here, Gilbert? I don't even know, but if you come up, you are not eligible to win today. So let's give it a whirl. RJJ, oh, here we go again, RDB. There it is. Robert, what do you want to do? It sounds like we are going to get a lot of Robert DBs coming up shortly here. Thank you, Paul. Appreciate that. Man, he's like a magnet. Robert DB is like a magnet. You know what? I am going to spin again. Robert, we'll take care of you, but I'm going to spin again also. Let's see if we get another one here. Oh my God, no way is it going to be again. Holy cow. RJ, are you in the house? Both of you gents, send me an email with all of your vital information, address, swag size. RJ, you still here? There we go. Wonderful. Thank you for Robert DB. Okay, post it up here, prosperswag@prospertrading.com. Please send me that email. And tomorrow, everybody, we will pick up a continuation on calendar spreads, but tomorrow we'll focus in on how you would potentially trade a calendar spread for an earnings play, because it's a complete different ballgame. All right. So thank you, everybody. Thank you. Okay, we got the Fed meeting today. They will be making their announcement tomorrow. But right now, it seems like that and tariffs taking a back seat to what is going on in the Middle East. All right. Oh, I just noticed RCL getting hit here. I wonder, we got to be close. We should be getting pretty close to $3 partial exit there. So thank you very much, everybody. Have an amazing, amazing day, and we'll see you all tomorrow.